Hey guys, welcome back to the channel. I hope everyone is doing okay. So now that QQQY has been out for about a year now, I thought it'd be a good idea to kind of go over like the 12-month results. So similar to the Tesla video that I did recently, uh, I think it's a good idea to maybe see like how dollar cost averaging could help, or maybe not, on triple QY. So I assumed like you did like $1,000 per month. So as you can see, like the dates of that you bought like at the close of the day before like declaration date. So then like for example on September 28th, 2023, so the closing price was $58.77. So if you put in $1,000, then you could get 17 shares. And then if I scroll down, you can kind of see like all the like the results so far, and then like you'll also see like the total shares in the column after the invested column. So 12,000 invested in total, so that gets you about 244 shares. So let me see if I can scroll over just a little bit. So then you also see like the payable date, and then you also see like the in the column next to it, that was like the original, like for example on October 5th 2023 you got paid a buck 10. But then you also have to factor in like the 1-for-3 reverse stock split. For some reason they Defiance didn't update their like what your distribution would have been. So I just did it manually in the column called distribution per share. So like a buck 10 times 3 is 330, and you'll see the rest, so on and so forth, all the way up until like this September 5th payout. But that was already like after the split. So if I scroll over a little bit more, so then you can see like the payday, and then the cumulative payday would have been $3,821.80. So, and then if you factor in like the September 19th closing price, was at $36.11. So unfortunately your value was 8,813 and 28 cents. So like you originally invested 12,000. So unfortunately your price return is negative 26.56%, but your distribution return was higher, so at $31.85%. So that gives you a total return of 5.29%, which is actually kind of funny because that's almost like a little bit higher than like what you would have gotten if you just put your money into like a money market or like a treasury type of fund. So again, like triple QY did a 1-for-3 reverse stock split. But then I also wanted to do something interesting in addition to just like dollar cost averaging. I also wanted to see what would happen to like the returns if you happen to buy at the low of the day. So again, let me just scroll over a little bit more over here so you can see the actual results, because I think that's what people care about. So it's very similar to price return. You still lost 26%, but your distribution bumped up a little bit to 31.96%, and then like your total return is slightly higher at 5.66%. So let me just go back here to the regular DCA at the close. So it's like 5.29% versus 5.66%. And then I also wanted to do something interesting too. Like I also wanted to do like I couldn't find like a good name to do this. Like I call this a DCA YOLO, but it's not like a true YOLO where you just like throw like all your money in. I still assumed that you put in like 12,000, but I assumed you put like $1,000 to kind of test out on September 28th, 2023. And then like 11,000, like let's just say like maybe you thought, oh, I don't trust this fund, so I wanted to put 11,000 like near the end. So if I scroll down, so you can see the August 29th, 2024, that I put $11,000 in, so then I actually get more shares, 279, and then like the total shares would have been 296. And if I scroll over a little bit over here, your payday actually gets slower just because like you didn't get a chance to get the benefit of like investing like the full $12,000 in the beginning, so that's why your payday is so poor. But your your mark to market, like the 10,000 you get, like at the end of the day you will get 10,688 and 82 cents. So you only lost 10.93%. So in that regard, you lost less, but it's still not, still, you still don't feel good. And the distribution return is actually also lower because like you waited until like near the end to kind of put in like more money. So like as of now, you would have like 12.5%, and that's only good for a total return of like 1.57. So in this case, like kind of waiting like all the way to the end wouldn't have helped. And here's like the surprising part. So I did like also, I assume like you were able to buy like near the lows on September 28th, 2023. But I also kind of wanted to see like what would happen if you did like a lump sum in the beginning. So if you put in like all $12,000 on that date, you would have gotten less shares, 206 shares. But if I scroll over here, you notice your payday is 6,426 0.36. Oh wait, something's not J. Oh no, that's right. Your payday is actually more. So because like, you invested up front, so you had more time to accumulate like all those distributions. Phew, sorry about that. I thought I made it like another spreadsheet error, but this is actually okay. So unfortunately, your mark-to-market return, uh, like like your ending amount would have been 7,441 and 52 cents. So that's a bad price return of 37.99%, almost 38% loss in terms of like the on like the nominal price. But however, you were able to accumulate 53.55% in terms of distributions. So your actual total return is actually better if you would have put in like the lump sum up front. But that still assumes like you were able to buy near the lows of $58.23. So your total return is 15.57%, which is actually pretty respectable for this particular ETF. And it's also actually higher than what I would have thought. Like if you had done like a DCA at the lows, and then just as a point of comparison, like if you just put like the money in regular triple Q September 28th, 2023, and you held it all the way to September 19th, like almost a year later, you would have gotten like a 35% return. So the for like a cover call, like a in the money cash secured put ETF, you would expect it to return lower, but not like this low. So even with like a if you invest like a lump sum, it's still not as good as if you just held the actual shares. Of course, like you probably would have been pulling your hair out just because of the volatility. So I hope people found this interesting. It's not what I thought, but if you look at the distributions per share, you'll notice like up front, like you got like these three almost like $3 paydays in the beginning, and then as you kind of like scroll down, you don't really hit that um, until recently, like the $3.46. And part of this is just due to like you had periods of like low volatility, so the fund can only collect what the market gives it, and then there's also like kind of like tourist erosion, like after the split as well. So that unfortunately like hurts the returns. So again, I hope people found this interesting. So thank you for watching. Please like and subscribe, and I'll see you in the next. Actually, let me just make sure like I pull it back in the frame just so people can see again. So if you did a lump sum, 37.99% price return, and if you compare it to like a regular DCA, if you DCA, you have like less loss in terms of like a price, but then you also have like less distribution return as well. So that accounts for a good chunk of the difference. So again, thank you for watching. I hope people found this interesting, and I hope people make good money out there, regardless if you hold this particular fund or not. And I'll see you in the next video. Bye now.